is going to tell you a little bit about myself and just my firm and like what we do, and then I want to just keep it interactive. In the last one, I had like a packed house, so I ended up just talking. But I actually want to have a dialogue, so don't be shy and like ask some questions. So I'm David Becker with a firm called Time Equities. We're headquartered in New York City, real estate investment development company. We're owner-operators, developers, builders, et cetera. Typically known as more of a value-add, longer-term owner. We're private, but we've been around a long time, being founded in the late 1960s. And we have a very diverse portfolio of assets. We're all over the place. We're in 35 or 36 states. We're all over Canada, Western Europe. I think we're in 6 countries in Western Europe, and the Caribbean. We have a project in Anguilla, which I'm going to on Thursday. Yeah, site visit. Well, you know, it's funny. It's a, we own, sort of operates like a boutique hotel, but it was, you know, but we have a land that came along with it, and over a period of time, we're developing a marina there. So I'm actually going on a tennis trip, in fairness, but our chairman goes, a couple of key Time Equities people go, and then some others, and ends up being a great time. You sit around the same table, you just eat, drink, you play tennis, it's cool. Listen to some reggae. So yeah, I digressed. But we own really everything from office to retail, industrial, student housing. We build buildings. We just completed a tower in downtown Chicago called 1000M. So we're a highly diversified real estate investment company. I think we have 400 plus properties. We have about $7 billion in assets. And keep in mind, we're private. So obviously, over time, we've had, you know, many opportunities to either go public or have large institutional accounts. And, you know, by choice, we've decided not to do that. And that might change as our chairman sort of slowly transitions the firm as we're transitioning in terms of bringing those strategies on. But fundamentally, we're long-term holders. And I thought I would start by just sort of asking everyone, come on in. All good. Yeah, I thought I'd just start by asking everyone, like, you know, if they really understood what equity was. And when I say that, obviously we have a very smart conference here. I could tell by every person I've spoken to, and I can also tell by every thing I've sat in on that you have like very ambitious, smart professionals here, which is great. But I personally find, just because maybe I'm on the equity side and I started as a deal person, that a lot of people don't have a full understanding of the equity. So like sometimes they're in their different silos of what they do. And to me, and I sort of tried to do this, another person, one of my Time Equities team members that's here is Kim, who was in our last session. But we're strategizing about what message we should sort of come up with here. And it's sort of like, well, equity is the seat at the table. And so I'm just curious what everyone thought equity means to them. And it's not a trick question, by the way. Like, but I mean, if I just context it out, anyone want to raise their hand? Go for it.
Yes, I also work at a PE shop, but I think like in its simplest terms, it's having skin in the game. But then on like the other side, it's like just having access to capital is what the basis of like having equity is.
But why do we want it? Like, what? Yeah, go ahead.
First loss position, access to the upside that comes with investing, decision-making, strategy, et cetera.
First loss position, that was a good way to put it. It's technical, but accurate. So one of the things that when I started my career, people would say, oh, well, you need equity for this or equity for that. And then I started digging in, like where does it all come from? Meaning, like, you know, I know there's some big institutional shops here, and are they the equity, or are they getting the equity? So it's like, go down that trail. Where is the money actually coming from? It makes me think of that movie, Too Big to Fail. So I don't know if some of you had seen it, but in 2007 and 8, it was a story about essentially the market collapse then. And I remember in the movie, Lloyd Blankfein, who at the time was the Goldman CEO, called Warren Buffett because he needed the equity. So Goldman, who you think is, I know they're banking and whatnot, but they're equity, and he calls Warren Buffett. And I always think like the equity is the person actually writing the check. That's really, the equity. It starts somewhere. I like to think about it like it's ownership. So what I love about equity is, or being in that side of the business, and just to give you a little more context, so I head up our capital markets and manage all of our investors, and I'm going to get into the different ways you could raise capital. But, to me, if I had to use one phrase, I'd say equity is like freedom. Ownership freedom. It's basically, if you're the equity, you have the ability to determine like which direction you're going in a project. You have the ability to determine where geographically you're going to invest, what you're going to invest, how long you have to hold it, et cetera. So a lot of times when I hear equity, and I think, well, equity, it might be a big PE shop, might be endowment and whatnot, but they're sort of dictating the terms. So if you're getting that kind of equity, you sort of have to think about you're not really the equity. So once you sort of understand equity, you think about how different parts of the business it touches. So to me, it touches every part. It touches the brokerage leasing side, and again, it could be that the equity of the brokerage leasing side, asset management, acquisitions, it all sort of circles around, well, who's putting the money in for the deal? And what's nice about it is if you're on the equity side and you can play a role, you can influence what is being bought or invested in or done, because ultimately it's the control piece. So I was going to break down what I thought very high level, because I don't know in this room how many people really have a full understanding of it, or how they think they can get it. And by get it, I mean two things: raise it, right, as a capital equity provider or working for someone that is on the equity side. Could be a big fund, could be a private player, whatever. And then there's how do you get it individually? And they actually sort of mean two different things in my mind, because to me, when I say it individually, I'm like actually telling you should try and get equity for ownership long term. If there's one message I'm leaving you with, it's that. So I probably opened up Pandora's box in terms of like you guys all going back to your home offices and being like, I need some equity. But I wish, when I was younger in my career, I had someone guiding me that is actually what I should be thinking about. And that's not to say that you should sacrifice, people are always like, oh, you can get equity if you make an investment. Well, that's true, but you have to have the cash. Sometimes younger people or whoever you are don't have the cash to invest, and to invest meaningfully. And, you're sort of subject to then just the vagaries of not being able to get it or whatever, So to me, it's important to learn how to make a contribution where you can get equity ownership by making a contribution in another part of the deal. And that could be, well, I brought a great vacant building, I brought a tenant. Good, get some equity. I managed it really well for X number of years. Good, be vested, get some equity. So that's really like sort of the takeaway. Whatever equity you don't get, I guarantee you in 10 years you'll regret. This is probably a great time, because if you buy something in a reset and you're able to get something, and we can talk about a couple different strategies about how to get it, or how to raise it when we get into it a little further, but I just wanted to context it with that. We see a lot of different partners, a lot of different structures. It's creative. because like when you're at the equity table, you can get really creative. Usually we'll buy some things with problems or partner issues, or and you can sort of, to the extent that you have staying power, it's really helpful. I'm going to open up the floor a little bit. Any questions? Or anyone want to hit on anything in particular? Don't be shy. Go for it.
Yeah, I guess more curious on your story. You say you don't have any like limited partners that you speak to. Is that
No, we raise money through a variety of ways, which I'll get into. But no, we're managing a whole group of investors. We're not beholden to anyone because we're hyper diversified, and every single asset we own is single and separate with with a grouping of different investors. So it's a little unusual. Like we own 400 plus properties, but every single property is in a single purpose entity and could have a different investor structure with a different group of investors that might relate to that particular property. So that gives you a lot of freedom and flexibility because you're not really beholden to any one player. So typically, like if you have one source of equity, well, they're really dictating your business. So, that's fine. But it doesn't allow you to sort of maybe work on the things that meet your vision.
Yeah, and on that note, as far as like your ability to scale using that strategy, I mean, do you find that was more challenging to do that on like the scaling your business over time versus having a larger private equity group kind of backing you and saying, okay, diversify across this and we'll help you scale. Like, I guess what are some of the drawbacks and pros and cons of those two things that you're seeing?
And we can talk about the structures. But I will tell you that if you asked me, I would say I want both. As long as the institutional model is not exclusive. Meaning as long as we can do what we want to do, I would tell you we would probably have both. The founder of our company is traditional, unbelievably successful, legendary real estate investor, a guy named Francis Greenberger. Started at age 16, came from nothing, but was a real American success story, and bought his first building while he was a minor. Had to have his investors sign the paperwork, and then that fed into a whole bunch of things. He was big in New York, and then in the 90s decided that he was over-concentrated in one market and one property type, and that was basically during the S&L crisis, and then that fed into a wide range of stuff that we bought. Scalable, so we are a broker-dealer, so where we took it scalable, and you can always go bigger, is we used to syndicate one-off deals to friends and family. And the advantage of that is you can typically get a very good deal structure, you have flexibility, everyone's getting direct tax benefits, and you're likely putting a group together that you can, I don't want to say control, but you can guide in a way that at least meets your vision for what you want to buy. And then I also have a family office called the Becker organization. My brother runs that actively, but we still actively work on it together. And have sort of a lot of integration on both sides. But where we were able to scale it up at Time Equities was because we were a broker-dealer, we went and started raising money through the independent broker-dealer space. So maybe that question feeds into scalability, which is how you raise all the different ways to raise money. There's really 4 or 5 primary ways. You could be a public REIT, which if you think about it is retail money, but very costly. Typically, you don't see too many REITs that are hyper diversified. So they typically have one particular strategy, maybe one geographic region. If it's national or international, maybe it's national office or it's retail or it's malls or whatever it is. So that really didn't fit our core, even though over the years we've had many opportunities to go public based on our track record and our company history. But it didn't really work for what we were trying to do. It doesn't mean you can't have some sub-public entities, like there's something called a Reg A. You could do some things like that might work, but it didn't work for us. Then there's institutional. So that's really like what I see a lot in this room for the most part, which is funds that are essentially getting their capital from endowments and state pensions, and in large scale. There's challenges and positives there. Clearly, that's a way to scale, particularly. But I find that it's hard to break into that business. It can be, it gets very, very competitive, as you guys all know, because the only deals I heard were the large deals in that room. I didn't hear anyone talking about a $20 million deal. And we do a range. We do everything from 10 to 450 million, but I would tell you that our sweet spot is probably in that 10 to $60 million range. And that's by choice because we see more fat on the bone typically when we can be the bigger fish in the smaller ponds. Because it's sort of above, let's say, the mom and pop. It's below the big institutional threshold where it gets just hyper competitive. So it's more of a commoditized product. I mean, yeah, there's great deal people, there's great restructuring, but that's the best way to scale if you can get it, and they don't have a noose on you, and you have the ability to earn. That's one way. And then the third way, primary way, is how we do it, which is essentially we go to wealth managers, RIAs, and we raise money through what is the independent broker-dealer channel. And so we're a BD. We're managed by FINRA and have audits regularly with the SEC. But we're able to, because of that, go to wealth managers who have clients who will then bring us essentially the syndication model. So the way I describe it is it's like the friends and family model on steroids. Because you can go to one financial advisor and they can bring you 25 clients in one lump sum. And you're still getting what I regard to be a very, very good deal structure, flexibility, control mechanisms. Sometimes those control mechanisms are really important for the deal safety. And also sometimes the control mechanisms of the institutions become very important because it depends on how quality of a sponsor you are. So those are the, and then as a sub-particle of that, we bring in a lot of money, which is my favorite capital, is the 1031 space. And as he was talking at the end of his speech, he was talking about they also do DSTs, which is a Delaware Statutory Trust. We do it through a TIC model, tenancy in common. It just gives us more flexibility to own real estate traditionally, whereas the DST has a lot of restrictions on how long you can hold. Can you buy a value add? Can you refinance it? All things that are become very restrictive, whereas traditional 1031 model is, and by the way, why don't I stop there? Is everyone familiar with 1031? Does anyone have any questions about that 1031? Like,
It changed recently, right?
no, it was discussion of they were talking about killing it, but it's so far it's still alive. I mean, and just a little history on it. It's been around 100 plus years. Basically, it was the way the government wanted the industrialists and the rich real estate families to essentially keep their money on the table and reinvest in the economy, as opposed to put it under their mattress, which was not. So they encourage you, well, if you buy this and you have a gain, you keep it. And you keep the gain and you roll it into the next property as long as you follow these rules. So it's, I think, 1921. So, you're going on like 105 years. So there's a lot of history with the wealth in the United States. And, if you think about like real estate families, why do you think it lasts multiple generations? Someone always screws it up. But it's very good capital because there's a forced timeline. So even if you buy a building for 10 million, and let's say it doesn't go up in value at all over 10 years, but you took all the tax benefits, and so you've depreciated your basis down to $1 million, well, you have a $9 million gain, even if you sell for 10 million. So that's like a $4 million tax bill, as opposed to rolling 10 million into a new deal. So there's various ways you can do that. Because we've tapped the financial advisors, we get access to their clients also, and it becomes scalable. You could always scale up more. For us, scaling it would be hiring more people, not meaning like we could rev our engine by just adding people to rev. The problem, though, is then if you don't have the deals, and we all know how hard it is to find the deals right now, a good deal, well priced, and repriced based on the market, which I find has not really occurred to a large extent, then you know, it's you wouldn't know what to do with the money. So it's very hard to sit on capital. And we're not really, I mean, our own firm doesn't typically, we don't typically don't have negative leverage. So we won't, if we can't find positive arbitrage. So obviously we'd rather buy cash, meaning buy it for cash, or we'd rather finance it and fix it. So we typically don't float unless we have a deep value add and it made sense. Yeah.
You mentioned the favorable structure when it comes to sourcing investors through the RIAs. Can you talk a little bit about that, what that looks like, how that, you know, allows for more flexibility as opposed to institutional investment?
I'll shock you if I give you our structure, so don't let the sauce out of the room here, but like we typically have a 50-50 arrangement, meaning a preferred annual cumulative 6 and a 50-50. But if you think about it, you know, on a 10% deal, like we get 2. They get 100% of the first 6, and then we get, so that's very favorable. Whereas, of course, the institutions have looked back IRR, so the deal has to go phenomenally well for the promoter to really earn a piece of the pie. And when it does, yeah, it's great. But
And long term, that helps you too, because
Well-
you're not so worried about IRR.
right. So we really don't even, I mean, it's funny, in our track record, which goes back to 1992, and that was only because we couldn't get the, couldn't get the data in the 80s as much, so we just decided, you know, to roll back to 1992. But we started putting in the IRR only because it communicates a message on some reasonable basis to other professionals so they could like identify with it. Because what you would see in our deals is we have full cycle deals. Okay, those are easy to measure, and there will be an IRR in the full cycle. And then most of our portfolio, and we own 400 plus properties, is actually owned, still owned, where there's no equity in the deal. So if you're being honest, the cash flow is infinite. So how do you calculate that? You could apply some value, but then you're just guessing what the value is, and it's not, you know, didn't actually, you know. So, but the look back IRR is a challenge because, as everyone knows, I mean, it's not that easy. And it becomes very expensive quickly. On the other hand, when it works great, and you sell and you move on, and there's some strategy to that too. And I think, frankly, a firm of our size, like I encourage us to sell things every now and then, like even though our chairman, just based on how his philosophy has been, is really to sort of look at equity as more perpetual long-term equity. And so that's always like sort of a tug and pull, because when you want to raise more money, you want to customize to what the investors want. But yeah, it definitely helps us long term, particularly because you're able to, you know, you don't have any forced sale moments or whatnot.
And, sorry, so that 6% is sort of a cash-on-cash return. If you don't get there, then
Yeah, so it's a cumulative running. We do a cumulative running 6 pref. So if, you know, on a given year, if we were distributing 4, you'd have a catch up. So I mean, from the investor perspective, they get 100% of the cash flow until they've earned what I would regard to be a base acceptable return, and that number could be 6, could be 7, could be 5, whatever it is. That's just market driven, or you know. And then we start sharing the profits. We brought you a good deal, like we want to earn, you're earning, and we're partners from there. So you're very aligned in a true sense. So
Your investors stay in the deal for.
in our funds, yes. In our 1031s, yes. But occasionally we have people that want some sort of a measured exit, and in those deals we'll try and group people together and maybe put them in more development deals or deals that have more, you know, we buy everything from, we don't really buy core, we buy value add, opportunistic, but we do buy, you know, our whole model really is to buy stabilized cash flow with upside potential. To the extent that we can buy deep opportunistic stuff and there's no cash flow, we'll just accrue it. Yeah, go ahead.
You must be a better negotiator than I thought, that you agreed to a 50-50 split after 6% pref. That's like, I have not heard of those sort of a negotiated fee structure between investors.
Well, it's not, I mean, I don't know that it's so much that we're like better negotiators. It's where we're tapping the equity from. The pool of the equity is individualized. So the individual investor, for the most part, is looking for cash flow with very good tax benefits long-term over time. That's like at least the money that we're typically attracting. I think our brand, which has been very successful like over a multi-decade period, has enabled us to definitely reach certain thresholds that others might not get, but it's put limitations on us because, you know, obviously if we had to deal with an institution, that's not what our deal arrangement would be. But with the individual investor, which is really what you're doing when you go to financial advisors, is they're putting their individualized investors in direct real estate, not a publicly traded REIT, which I would argue is not really a real estate investment. I mean, think about what's happening with the REITs that you know today. Okay, the widget is real estate, but it's not, it really operates subject to the capital markets and the stock market. So go look at a Vornado chart, which could be good and bad. I'm just saying it's not traditionally fixed income with tax benefits in a stable way. Many of our investors rely on the income to live. They have families. It's like, meaning it's actual distributable current cash with tax benefits. So it's a different pool of investors. It's not, you know, so much. I think our brand has helped us get good capital, but it's probably held us to a certain point where, of course, I mean, every other day I'm in there with our chairman sort of saying, well, we could get a better deal structure, but we have to offer other things like liquidity in a way that would be helpful to the investor, or a defined exit, or whatever it might be. There's other ways to essentially like service the investor, but it has worked over time with us in that way. And also, if we sell something, we offer a 1031. So again, it depends on who your investors are in terms of whether, you know.
How are you managing kind of investor sentiment? Say you have a repeat 1031 in this turmoil environment that we're in, probably expecting prior success that they've seen with you. How are you kind of illustrating that that's likely not the case, and moving forward, how do you adapt?
So like, there's no one's immune to, like, particularly at volume, and we do so many transactions, to like batting 1,000. If you're in one of our funds, and it's typically then, okay, I think, you know, we're going to hit 80, we're going to hit 80%, you know, it's just like it nets itself out. But I think in the one-offs, you know, we buy a lot of deals with cash. That enables you to weather a lot of turmoil. We've gone through cycles before, both political and economical, just based on the firm's history. So the underwriting is probably, I would say, very durable, but we likely miss deals that we could have gotten that we would have done unbelievably well on, because we over-underwrited the crap out of it, and to a point where we over-reserved it. Let me give you an example of how we would look at a net lease. A 10-year net lease, we would look at, and, you know, like we would look at it and we'd have to underwrite so that at the end of the term, and that's if we believe the tenant was creditworthy, that we'd essentially have to have enough reserve buildup where we could fully re-tenant the building. So that means just our yield, we're sweeping cash flow. So in a market where Walgreens are selling for 5s, that never made any sense. And if you think about those kinds of deals, you're buying something for 3 times of production cost, what it costs to actually buy and build, and you're really their bank, because they have these extended long-term leases with options that have fixed increases. So like if someone said to me, what's your favorite asset today? I'd be like, below market leased industrial. Significantly below market leased industrial, because it's defensive. It's already got a below market lease, so we're buying a basis that's really, really cheap. And if there's problems ahead, we can weather it because we have a lease that's below market, and hopefully it doesn't go below that. And the upside is there, we just have to wait for it. It's like a lazy man's value add. So sometimes we just have a different view if you want to own the asset long term. A lot of people will look at those net lease deals and they'll go after I got a good yield, I got an 8. But, but what happens then, like when you're trying to sell the deal, like with 3 years left on it? And so to me, the value is depreciating, and I don't mean from a tax point of view. So the highest point of value typically is unless it's a below market lease, if it's a market lease, is basically at the front end of it. So who wants to buy something that's going down? So we'd rather buy something for a fraction of replacement cost than 3 times as much as replacement cost. So we have less problems because of that. But, how do we manage them? We hang in there and do our best. It's not a perfect world.
All things equal, if it's a ground lease for like a 1031, do you need a better return because you're not getting depreciation?
That's funny. You mean ground lease, like an actual ground lease?
Yeah.
Or you mean a net lease?
A net lease where.
Okay, so I make the distinction between the ground and the net. A ground lease to me is sort of like what someone mentioned in there, where he's bifurcating the ground from the building. I happen to love ground leases, but of course the return is always suppressed. But then it just becomes like a tradable sardine, But usually they're written where, the increases are so slow, and it's usually very good for ultra safety. So, sorry, the question on net leases again. Say it again.
So all things equal, if it's a fee simple interest
Mhm.
versus a ground lease, leased fee.
Yeah, well, you would expect a much higher return for a traditional where you have the fee as opposed to owning a leasehold interest, which doesn't include the ground.
Right.
So, it's all pricing. Our chairman wrote a book a couple years ago. It's called The Risk Game, but it was originally predicated off a speech that he gave, which is buy it right, it's your only chance. And it basically speaks about the pricing, all about you can make a lot of mistakes if you buy the right price and still come out. Real estate has a way of saving you. If you buy it at the wrong price, the perfect price, which is what I see a lot in the market, one mistake and you're cooked. And that's exactly what's happening with rates. People were buying low cap multis thinking like the debt would always be 2 or 3 or 4. And so they had positive arbitrage until reckoning day. And then rates went up. And when they refinance, it's exactly what the guy was saying. You have to add more capital. But fundamentally, your equity is lost. Or, might come back, but yeah.
And I just want to ask, what do you see right now in the equity market? Like, do you see it slowing down year over year?
I think there's so much capital in the market right now. It's just trying to find a home. Like,
Sorry,
yeah.
you think there's more least qualified product than there is capital out there, right? So
There's way more capital than there are good deals.
okay.
But, how many good deals are you guys seeing? I mean, the pricing really has not, it's very spot. Like if someone has a particular problem, that might be a problem. Like one particular, their maturity is up or whatever. It's not like cap rates on multis have gone to 8s. I mean, I came up in the business like if the interest cost was 6, 6.5, the multi was 7 or an 8. So what you have right now is a weird dynamic of actually, it was funny, he gave a 10-year chart, but it's so distorted, that 10-year chart, because you had 10 years at 2. Go back 25 years. The average rate is where it is now, which means the cost of the money is 6.5. 2 minutes? Okay. Final questions, yeah.
Just, you put on your GP hat for 1 second. So you see a lot of examples of an LP will force a sale from a GP perspective. Selfishly, the company I work for has purchased one of those where the LP was JP Morgan, they wanted to close the life of their fund, and they forced the GP. And in hindsight, everyone says, well, maybe the GP made a mistake there. Do you ever think that there are times where appropriate to give up major decision rights to execute on a project where otherwise it would not have happened?
Me personally, yes. I think, I respect the money. So to me, if someone's putting in the lion's share of the money, I always feel like the money should be respected. And that's because I'm an equity guy and because I care about my reputation and our reputation as a firm. So sometimes you have to yield to the money if the money, like if there are other investors, that's a more complicated question or answer. But when we have like deals where we have primarily, let's say, one investor or one group of investors, that's when we can defer major decisions because in the end, you're almost servicing their account, but with an economic interest, right? And so who's to say we know better if it's their money? So like a lot of times in the liaison or the, call it investor advocate, because it's so important to me that we're known as a shop that protects the money. But when there's multiple investors with different objectives that have different views, that's when you have to sort of follow your own instinct about what you think is what's best for everyone as a group. And that's where we try and facilitate certain investors out. In that scenario, the GP, if he had or she had believed that there was future upside, the wrong time to sell, whatever it was, well, they should have tried to recap, JP Morgan out. That's what I was sort of saying. Sometimes those decisions are driven not by the property, but some larger dynamic going on. And it doesn't feel good when you're on the wrong side of that trade, particularly when you are the one, to them it's just money, and particularly, let's say them in particular, like it could be a pimple for them, but for you, you've been working it, sweating it, living it, and so it's hard. And, of course, we have less of those because we have access to capital and have a very strong chairman who's worth a few billion. But look, it happens, and it's just a question of how you manage that. But I think it's important when your reputation is intact, which is to serve the investors. All right, I'm around if you guys want to chat further and find me or whatever. But appreciate you listening and coming.
Jordan's doing my work
Pleasure.
in Akron's if
Oh, cool.
Simon.